The broadcast is now starting. All attendees are
Good
in
morning
listen-only
and welcome
mode.
to the Landau Arnold Law Firm Tax Webinar. This morning, our firm will present key tax planning components of the Tax Cut and Jobs Act. This morning's presenters are Andrew Laufer, Managing Partner of Landau Arnold Law Firm, and Brian Dempsey, Director of Tax at Landau Arnold Law Firm.
Good morning. This is Andrew Laufer. I want to thank you for taking time out of your busy day today to attend this webinar. The reason for today's webinar is we have spoken at various McDonald's owner-operator meetings, and what we have discovered is that many folks who aren't our clients are not aware of the new tax saving strategies that should be implemented as a result of the Tax Cuts and Jobs Act. I commit to you that this webinar will not only be informative, but will show you how utilizing key components of the Tax Cuts and Jobs Act will allow you to effectively reduce your tax and keep more of your hard-earned money. In order to do so, effective and early planning is critical. We know that many of you will have questions. The way we plan on running this webinar is having all participants muted to eliminate background noise. We will, however, keep the question queue open, so please feel comfortable to submit your questions, and we will answer them during or at the conclusion of the webinar. If you have questions that you prefer to speak with us directly on, our contact information will be available also at the conclusion of this webinar, and we encourage you to reach out. When I think about planning, I always think of this quote from Alan Lakin: "Planning is bringing the future into the present so that you can do something about it now." It is my opinion that without early and comprehensive tax planning, your hope of reducing your tax burden is nothing more than a wish. Our goal today is to help make tax minimization a reality and to help you keep more of your hard-earned money. Today's agenda will include Section 199A, a depreciation overview, business interest expense limitation discussion, employment-based tax credits, and if time permits, state tax cap conversation, as that would limit on your personal tax return. It is important to note that the Tax Cuts and Jobs Act in its current written form is in excess of 1,500 pages. And yes, I said 1,500 pages. And this continues to grow as changes and explanations are being added. As a result, it is important to understand that today we are covering a very limited portion of the legislation, highlighting the key components that will impact your business. The first topic on our agenda today will be Section 199A. Now, 199A is very complex, and we can literally spend a day talking to the intricacies. Our objective this morning is to explain how proper planning will help you maximize the benefits of this section. At this point, I would like to invite Brian to join the conversation to talk about 199A.
Thanks, Andy. Good morning. I'm glad we're starting with Section 199A, as this is an area that with proactive planning, a taxpayer can truly maximize their benefits and minimize their tax obligations. Now, a little background on Section 199A. It pertains to taxable years beginning after 2017 and before 2026. It also provides a 20% deduction on qualifying trade or business income to qualified business entities only, and C Corps are excluded. Again, C Corps, they are excluded from the Section 199A deduction. We get a lot of questions often from our clients if they should be a C Corp. And the answer is it truly depends. For those of you that are not our clients, this is a conversation to have with your tax advisor so you can take advantage of the significant savings of Section 199A. Now let's discuss how the potential 20% deduction is determined. It's important to note that this is a multifaceted calculation, and the calculation is applicable to any qualified trade or business. I'd like to focus your attention to this slide, and please excuse me, it's going to be a little dry as I'm reading directly from the slide, but it's important that you hear it this way. The amounts determined under this paragraph with respect to any qualified trade or business is the lesser of 20% of the taxpayer's qualified business income with respect to the qualified trade or business, or the greater of 50% of W-2 wages with respect to the qualified trade or business, or the sum of 25% of the W-2 wages plus 2.5% of the unadjusted basis. Now, it's important to review with your tax advisor these rules as they pertain to your organization, because with entity aggregation and QBI loss carryforwards, they can both significantly impact Section 199A calculation.
Brian, boy, that is absolutely a mouthful. This is obviously very complex and can be quite confusing. I think it's best for us to present via an example how to effectively plan with Section 199A.
Andy, I agree. So let me walk you through an example and show how with proper planning, Section 199A can provide a significant tax savings. Now, if you look at the slide, Ronald McDonald is an owner of a qualified business entity, and here are his facts. The business had taxable income before company W-2 wages of $1.5 million. The company paid out a total of $500,000 in wages to include Ronald himself, and they had minimal investment. As stated, Ronald had taxable business income before W-2 wages of $1.5 million and has company W-2 wages of $500,000, leaving the organization with qualified business income of $1 million, which can be seen on line 3 of the example. To calculate the deduction, we must first calculate the limitations. The first limitation is 20% of qualified business income, which in this example is $1 million. 20% of $1 million is $200,000, as can be seen on line 4. The second limitation is based upon 50% of the company W-2 wages, which in this example is $500,000. 50% of $500,000 is $250,000, which then can be seen on line 5. On line 6, the lesser of the above two limiting calculations is the 199A deduction. And the 199A deduction, again, is the lesser of the two calculations, which is $200,000, leaving taxable income with the Section 199A deduction at $800,000 versus the $1 million if you did not qualify or plan correctly for 199A.
Brian, thanks for explaining that. The 199A deduction and its limitations. As can be seen in this example, that tax benefits are equal to a savings of the difference between $370,000 or $296,000 for a total dollar savings of $74,000 of post-tax dollars in your pocket. And if you note on line number 9, the reason for that is your effective tax rate falls from 37% to 29.6%. So the savings are significant, especially as your income levels will rise. Aside from how this calculation works for the 20% QBI deduction, Brian, there's one thing that people need to make sure they pay extreme attention to, and that is the limitation as it pertains to the W-2 wage calculation. And there's much planning that needs to be done here. Can you please outline the impact of W-2 wage planning, especially as it pertains to the shareholder or owner's compensation?
Yes. So in this example, which you see, I will explain the importance of planning for reasonable officer compensation and the benefits of not having excess compensation. Please keep in mind, it is critical to discuss with your tax advisor what is deemed reasonable compensation. Now, we have taken the facts from our previous example, and if you recall, Ronald's company had total company W-2 wages of $500,000. Of the $500,000, $250,000 were Ronald's personal W-2 wages. Our example is meant to show the tax impact of arbitrarily or not planning for reasonable officers' W-2 compensation. In this example, income before owner W-2 wages is constant. The only change is the increase in the owner's W-2 wages of $250,000 $500,000 and $750,000, which can be seen on line 2. On line number 3, you will note Ronald's qualified business income declines as the amount of owner's W-2 wages increase, which would make sense as we are adding additional expenses, which in turn reduces the amount of income subject to the 20% deduction. If you will follow along to lines 7 through 11, we have calculated what the true post-tax cost would be of the additional owner's W-2 wages. We took into account for the additional payroll taxes now incurred by Ronald instead of passing through as ordinary income. On line number 12, you will see why we cannot stress enough the importance of proper planning, because the effective impact of the total tax due on income can be as great as $49,000 of actual cash in your pocket from this scenario. Please do keep in mind, every taxpayer's situation varies.
So again, Brian, this is great information and continues to emphasize the importance of planning. One significant planning note is that W-2 wages, those must be the wages that are paid in 2018. So as you do your year-end bonus planning, or your thoughts are about how you pay in year-end taxes, please make sure you communicate with your tax advisor to make sure you do not just arbitrarily drive up your W-2 wages and jeopardize maximization of the 20% deduction that you will get as a result of Section 199. Now, Brian, one of the next things that, we've had significant changes in the rules that will apply to our clients is in the depreciation rules. These rules and changes are really significant. I'd like you to outline those changes for us.
No problem. So the two key changes in the area of bonus depreciation in Section 179. Regarding bonus depreciation, the rules have varied through the years. The most significant change is the ability to deduct 100% of qualified property as compared to the prior 50%. But it gets better. It gets a lot better. Whereas prior rules regarding bonus limitation were only applicable to new qualified property, 100% expensing is not just limited to new qualified property, but it could also be applied to used qualified property.
So a simple change by increasing the percentage and bringing in the ability to use on used qualified property is significant. But there was also a significant oversight, in the legislation. And that oversight falls in how leasehold improvements are being classified. It would be critical that we discuss what that oversight was.
I agree. So due to legislative oversight, the law actually accidentally excluded the category of improvement property from 100% bonus depreciation. Because of this oversight, many interior improvements to buildings are no longer eligible for the provision and will be required to be written off over 39 years. This oversight can be seen in the chart attached to the slide. What I can tell you is that the AICPA, as well as many business organizations, have been pressuring their elected congressional leaders for a technical correction. It's important to note that this correction may or may not happen before the tax filing due date, and a planning thought would be to maximize Section 179 depreciation if possible, or to file an extension with the hope that a technical correction will come and you will be able to claim the bonus depreciation. This is a critical planning discussion to have with your tax advisor. Now, the second significant change was the Section 179 depreciation by raising the ceiling for deductibility from $500,000 to $1 million with a $2.5 million phase out. Again, you should discuss it with your tax advisor. If possible, the Section 179 depreciation expense can be used for your leasehold improvements.
Brian, I know that you would agree that we cannot emphasize enough how important this classification is, especially as it pertains to leasehold improvements and managing the methods of the depreciation we use. I know we have learned by utilizing all options and managing to our clients' current and future year tax brackets that sometimes opting out of bonus depreciation or not taking Section 179 can reduce taxes over a multi-year plan. And this planning can be extremely effective in reducing the taxes one will pay over a few year period of time, which will effectively put more dollars in our clients' pockets.
Andy, you're absolutely correct, and I think we can best show this in an example. Now, Andy, if I was a restaurant owner-operator and I had 4 stores, 4 restaurants, my depreciation from prior years was 0, and my current annual debt service through 2020 is $475,679. Having an organizational cash flow pre-debt, G&A, and owner's draw of $1.4 million with a G&A assumed at $200,000, my BBV 2020 capital improvement or project schedule would be 2 projects in 2018 for $1.2 million, 1 project in 2019 for $600,000, and another project for $600,000 in 2020. How would I be able to plan or see the impacts of the 100% bonus depreciation versus standard depreciation?
So we've created a scenario here based upon the facts that Brian just presented. On the left side of the table, we are looking at what cash flow would ultimately look like with 100% expensing, and on the right with what we would refer to as standard depreciation for the 4 BBV 2020 investment projects over the next 3 years. As you will note, cash flow before debt service and income taxes will be the same in either scenario. There will also be no change in owner's draw except for draw as required for income taxes. As can be seen by the blue highlighted boxes, with 100% expensing, the actual cost of income taxes over a 10-year period is greater with 100% expensing than the income taxes utilizing standard depreciation. Some people might find that surprising. That's why planning becomes so critical. If you look at the column on the far right, the blue column labeled net change, the major advantage of taking bonus depreciation up front is in the first 3 years, cash flow is significantly higher. Now, when one would consider time value of money, and one would also consider that they have debt that might be rolling off, it would make sense in certain instances to take advantage of the bonus depreciation or Section 179 to gain the cash flow up front. But all must be clear that when depreciation goes away, they will still have debt service of which they will have to take care of, and their cash flow will actually be more negative than it would have been if they had standard depreciation. So the planning point here is that multi-year planning in every instance is important. And we are not blanketly stating that you should or should not take bonus depreciation or Section 179. We're stating that every situation is different, and you must look at your organization and make a determination what is best, for you, especially as you'll be taking on new debt, for the projects moving forward.
Andy, thanks. That was great, and it gives a lot to think about for planning and future projects. One thing that you'd mentioned was company's debt structure. I think this would be a great transition to go to our next topic on the agenda, which was the business interest.
Brian, you're correct. Another component of the tax legislation was that there is a provision that will limit your business's entity's ability to deduct interest incurred on debt. As recently as last month, November 26, 2018 to be exact, the IRS released proposed regulations on business interest limitations. The proposed regulations encompass 439 pages. Thus, it is obvious that these regulations are quite complex, and unfortunately, they apply differently to different business entity types. Because the proposed regulations were just issued, and we're digesting them ourselves as well as the rest of the tax community, much is still left open to interpretation and clarification. As such, we strongly recommend you understand that what would have in the past never have been a thought about business interest being a limited deduction. It just was deductible as long as it was business interest. Now with interest potentially being limited, it is critical for short as well as long-term planning due to the changing nature of these rules that you consider the impacts to your organization. On this slide, we have given you some of the highlights, but I encourage you to make sure you stay aware and discuss this with your tax advisor as more clarity becomes available on these rules. I will also emphasize it is potentially possible that McDonald's businesses or enterprises will not be subject to the limitation. We are working to get clarification on that, and that we will share with you in the future once clarification is received. So now on to another way to put more dollars, in your pocket. An area that we, wanted to highlight today is the opportunities for employment-based tax credit programs. As we talk with our clients and meet potential clients, many do not take advantage of the various federal as well as individual state employment-based tax credit programs. These programs are generally no cost to you as the employer unless a credit is obtained. We have seen these credits for some of our clients exceed $1.5 million. Others have gotten in excess of $500,000, $600,000. It is obvious that there is substantial money available in these programs. We encourage you, if you are not participating in any of these tax credit programs, that you look into what programs are available. But please note, the federal programs are available to all taxpayers regardless of the state that you operate in. In regard to state programs, many of our clients located in states such as New York, New Jersey, Georgia, California, to name just a few, offer significant state employment credit programs that can, again, provide significant dollars to your organization or to you personally. If your tax advisor does not provide support in this area, please reach out and we can assist you, even if only in the tax credit space. So, Brian, looks like we still have a little bit of time here. Why don't we touch on, the state tax cap, and what some of the states are doing so people can stay abreast of the rules?
Sure, Andy. So as many of you know, most of the states, they have unsuccessfully tried to set up state-level charitable funds to offset the state tax deductions. And the IRS has directly stated that such deductions will not be allowed. There is one state, however, which is Connecticut, that they've created something a little different, and the IRS hasn't said no to it. So the thought that other states may or may not adopt this in the future, that could be very much the case. So what Connecticut has done is they've created a pass-through entity tax. And what a pass-through entity tax is, on the entity level, they are taxing the entity pass-through income and then flowing a simple tax credit through the shareholder or the partner, so that on your personal return, instead of having taxes paid to the Connecticut or paying taxes to Connecticut, you're simply just having a credit to offset your income, thus freeing up some room for your property taxes or state taxes taken out in your W-2.
Well, Brian, I think we covered as much information as we could within the 40 minutes that we wanted to keep this webinar, active. This is going to conclude the structured portion of the webinar. Again, as I, always state, planning is just critical. These are significant changes. These changes are the biggest in tax legislation since 1986. Staying abreast and understanding the rules is critical to put more money in your pocket or to quite simply keep more of your hard-earned money. We at Landau appreciate the opportunity to work within the McDonald's community and are here and available for questions for you as you are attending this webinar today. The next slide will give you our contact information. If we don't answer your question on this webinar, or if you have a question post the webinar, please always feel comfortable to reach out. If you are watching this webinar subsequent to our live presentation, you can also reach out by emailing either myself, Andrew Laufer, at alaufer@lalcpa.com, or as Brian has, Brian Dempsey at bdempsey@lalcpa.com. We will now take a pause and open the queue for questions. Thank you all once again. Okay, questions are starting to come in. The first question in the queue: what range of tax savings will a typical McDonald's owner-operator see with Section 199A? That's an excellent question. And the answer is that there really is no typical savings. Every organization with proper planning will be able to take advantage of Section 199A. So as in our example, where someone had $1 million of income that was able and qualified for the Section 199A deduction, and they had enough wages to be able to provide the correct floor, they were able to reduce their income by $200,000, thus only pay tax on $800,000. The similar will be true if someone made $100,000. Instead of paying tax on $100,000, that taxpayer would only pay tax on $80,000 based upon the circumstances as we described. So the critical planning component is to make sure that you have a qualified business with your McDonald's enterprise is. Make sure you have qualified wages, W-2 wages. They must be W-2 wages. And then work with the best planning possible, and you will be able to get a significant benefit from Section 199A. The next question that we had: will the New York minimum wage credit be extended after 2018? Brian, you want to answer that question?
Yes. So as of now, it hasn't been extended. We are staying on top of it. If it should get extended, we will find out immediately and notify you. What I can tell you is that you will have some participants that qualified under minimum wage that also will qualify under New York Youth. And with the increase in the New York Youth credit, you might break even, you might not. It's something, talk to your tax provider and just ask, how your credits are looking this year as compared to last year. And I'm pretty sure you'll be happy where you are this year. But again, to answer your question, they have not been extended.
Thanks, Brian. Next question we have: is it better not to take accelerated depreciation on new assets? So I want to be clear. We are not saying it's better to not take bonus or Section 179 depreciation. What you need to do is you need to look at your individual organization and do a multi-year plan so that you could look at what tax bracket you would be in currently, what you're projecting your tax brackets to look like over the next few years. With proper planning, bonus depreciation or a combination of bonus or Section 179, maybe taking it all up front is the right thing for your organization. Maybe taking none is the right thing for your organization, or maybe taking a hybrid is the right thing for your organization. But just adopting one philosophy of we do or we don't would truly not, be tax planning, and certainly would not be customized tax planning. Okay, next question that we have in the queue. Does Section 199A deduction apply to an S corp that has units that are owned by a grantor trust? And the simple answer to that is yes, Section 199A would apply. Next question that we have: do you recommend getting W-2 wages for 2018? It is critical that you know that W-2 wages are part of the calculation to determine whether or not you qualify to get a Section 199A deduction. Because of the fact that there is a calculation that looks at 20% of what your qualified business income is, or 50% of your W-2 wages, and it is the lower of the two. If an organization had no W-2 wages, well, 50% of zero is zero, and zero would be lower than 20% of the qualified business income. Thus, with no W-2 wages, a business owner would get no tangible benefit from Section 199A whatsoever. So again, it's critical that all look at how they have their wages, and they also need to look at aggregation, and this is another critical planning, point that you need to have with your tax advisor. Let me see, right now we've gone through all of the questions that are in the queue. I'll leave this open for a moment to encourage anyone else that has any questions. Okay, so it appears that we have no more questions. Again, I want to thank you all for taking time out of your day. We look forward to being able to be here to provide answers to any questions that you have. If there's any critical takeaway that you got today, it is that with effective planning, you can absolutely put significant dollars in your pocket by utilizing the current tax rules to your advantage. Thank you very, very much, and you have an awesome day.